All right. Well, let's go ahead and go. Good afternoon, investors. Welcome back to our July 18th, 2023 edition of Bull Sessions. My name is Mark Robertson. I am joined here by Ken Kavula. Good afternoon, sir.
Good afternoon, Mark. Glad to be with you. I see you found a picture of Darla for me. That's great.
I did. For those of you who may be wondering what in the world's going on, we'll come back to Little Rascals here in a minute, but Ken apparently has an infatuation not just with Maria Bartiromo, but also with Darla.
I've I've become way less infatuated with Miss Bartiromo since I've learned her politics, Mark, and that's enough said. Okay.
Oh, okay. Well, I've got some quotes for you here in a few minutes, and you can
All right.
dissect those and have some fun. Speaking of Little Rascals, we're also joined here by Matt Spielman from Houston. Good afternoon, Matt.
Good afternoon, Mark. Good afternoon, everyone.
So we were digging into some of the reports that have been going on, and again, the regional banks seem to be doing pretty well. One of the slides in today's deck actually includes a closer look at Servisfirst, so it'll apply to much of what we see going on. So again, we are kind of referring, this was actually a term coined by Sean Mace about the Russell 2000 stocks. We couldn't use rabbits because they're not all growth stocks. Some of them are bargain basement value opportunities when it comes to the Russell 2000 and those small and medium-sized companies. But we didn't want to limit the field to just our traditional growth. We want to look at all of that stuff and see what type of opportunities are there. Ken's in there next to the dog again, and we did have several people can name all of the Little Rascals shown by email over the last week. So, and then
Well, you were asking about Spanky, and you caught a picture of Spanky right there next to your head, Mark.
Yeah, we're good. We're in the Spanky mode. So Darla continues to crush it. Maria's by the dog. She's in the doghouse, the Kavula doghouse, but that's all we need to say about that at this point. All right, let's keep rolling. This is your reminder that Portillo's is not sponsoring this show in any way, but they should be. Please get out there and support. As a shareholder at Portillo's, my wife and I would appreciate any stock price support you can get by ordering one of their hot dogs.
I just want to know how the heck you eat that hot dog, Mark, without getting it all over everything.
Oh, you just have fun.
Okay, all right, I got it.
Make sure you've got plenty of napkins and you just go for it. And it works. All right, here's our standard disclaimer. I see that many familiar names are in the audience. If you're new here, welcome. This is all about education and demonstration and illustration. It is all about the principles and methods of the Modern Investment Club movement. We are going to take a little bit of a twist and kind of bend the rules a little bit, spend a little bit on the more speculative side of the investing world, but we're allowed to do that because the real mission of the Modern Investment Club movement is to become aware of and understand and make the decision whether or not a certain approach makes sense for you. And so you're going to hear opinions from us. Please make your own decisions, and any buy transaction or sell transaction you pursue, make sure that it is your own decision after you do your own homework. If we own something, we'll try to make a point to disclose that. The roundtable, our monthly roundtable, is a webcast where 4 or 5 of us have come together since 2010. The actual annualized rate of return is hovering between 15 and 16% since July 2010. And the next one is a week from today, 8:30 Eastern Time. It is a webcast. You can come in your jammies with your favorite adult beverage and enjoy the session. If you'd like to be added to a reminder list, send an email to nkavula1@comcast.net. If you have any follow-up questions or suggestions, my email address and Ken's email address are at the bottom of the slide. Ken, anything else?
Well, I just want to tell our audience that if you get nervous during this presentation, just hold your fingers real tight, clench your fists a little bit, and just keep chanting up straight and parallel, up straight and parallel, and you'll be all right. It'll keep you calm, folks. I guarantee it.
Absolutely. Nothing that we discuss here is something that must be done. That is a decision that only each and every one of us can make on our own, really. All right. So things are actually cooking along pretty good. I saw that we had a very nice day in the market yesterday, and today it's behaving pretty well. So our Green bar on the far right is probably back at or even slightly above the long-term line of reasonable expectations. The green bars are a representation of the stock market as measured by the value line arithmetic average. The red dots are as if you had done individual stock studies on all the stocks in the value line standard edition and came up with the average return forecast. So you can see that that bubbles around. It hovers around 10.5 to 11% long term. It's currently at about 12.5, and probably going to be sticking in that 12% range for a while as things percolate along and we settle out from all that turbulence that was pretty extreme over the last couple of years. So Ken, there's your friend Maria, and I just thought that the three quotes were very nice, and they're not political.
Yeah, I think they're actually good, solid quotes that all investors can take to heart. It was getting kind of lonely as an individual investor 15, 20, 25 years ago when a lot of normal, everyday people didn't have money in the market because they weren't investing in 401ks or IRAs or things like that. But with the advent of those two tools, a lot of folks have become active in the stock market behind the tax screen, of course. They're not paying taxes on the gains right at the moment. But Maria's making the point that there's an awful lot of folks that can move the market if they choose to. I think that's a real interesting point to make at this time in history. That we don't have to let the big guys do all of the moving of all of the markets. We can do some of it ourselves if we're being reasonable and thinking about the long term. Unfortunately, I think a lot of the investors in certain age groups have bought into the I'm not rich today and I want to be rich next Tuesday philosophy, and that will kind of kill you in the market. Mark and I both know that. So
yeah, that doesn't.
Let's hope she's right.
That doesn't work out very well, and when it doesn't, it's pretty painful. And I
Yes,
guess
it
that
is.
middle quote there is one that I would center on as, again, we believe that George Nicholson's gift to investors as part of the modern investment club movement is this notion that there are mountains of information out there that didn't used to be easily accessible, and that has caused an information explosion. It's kind of fascinating that what we do still centers on relatively very few data points and trend lines for our analysis. So I really still believe that the stuff that Nicholson was doing 40, 50 years ago is still valid today. It's just easier to get at some of it. So
yeah, I'll tell you, Mark, that if you don't think that there's a lot more information out there, and I think that companies are being forced to be much more open with their shareholders because of the wealth of information out there from so many sources. You know, even if the company you're interested in did not have an investor presentation on their website 2 years ago, I'd go back to that company. In fact, I'd keep going back to it, and maybe even drop an email to the guy that's in charge of investor relations and ask him, where is your investor presentation? These are usually pretty well done, and they usually give a lot of basic information. If you're just starting to look for a company, that's a place where you can get information that 25, 30 years ago was completely unavailable to the average investor. You go there, you watch a PowerPoint, you watch it at your own pace, and you have some ideas about why you like the company more or why you like the company less than you did when you started.
Yep, absolutely. Good points all around. All right, here's our quick look at the Groundhog Challenge. And sorry, Matt, you've slipped a couple places. So we've actually bumped you from the slide for now. Good luck. Hope to see you back. But
oh wait, look at the par. I welcome further success. Pedro at number 7 is a good friend of mine. Love to see him there too. He's had a couple rough years because he plays a little bit more in the spicy end of the market. But just look at the pars of the top 10. I'm not worried.
Well, we were making the point, Matt, last week that at 1.2 million, this was still an open contest for the top 10 or 11 people on the list. I think that might have expanded to the top, at least the top 11, maybe even through the top 13 that are still anybody's game up there now. We're seeing real movement back and forth, and it's not impossible for these portfolios to move 1.5% to 2.5% in a single day.
True. Yeah. And I say look at the par, but knowing that NVIDIA is getting a lot of upgrades too, right? It looks done, but that's just because all the data is catching up to it. But yeah, any sport I enjoy more as a spectator or a player when it's good and competitive. Runaways are good for the winners for a while, but they get kind of boring.
Yeah, and any portfolio on this list of 40, Mark, that doesn't contain NVIDIA should get an extra gold star right now, you know?
Yeah, there's a few that happen to have it, that's for sure.
Yeah.
Well, I'll tell you, the one thing that I do find fascinating is that most of the institutional rhinos are not keeping up. And lo and behold, those of you that have been around here for a while, yes, that's not a typo. Kathy Wood is in 32nd place. And everybody look out. Arc Innovation has been pretty much on fire. That's largely fueled by Tesla, I believe, and a couple others. She probably has quite a bit of NVIDIA also. But
and in line with historical norms, the Wall Street Journal just talked about that Arc Innovation is down from a peak of 30 billion down to 9 billion invested.
Absolutely.
People left just in time to see this, or just before to see this.
Well, I actually own a few shares of Arc Innovation, and with real money. So I'm pleased to see Kathy return to that level. The monkey is still way off the chart at 162nd. And you can see that that's a 2-day change for Kathy Wood. It says 43rd on the right, but she's up to 32nd. I just forgot to change that. The average groundhog now has a positive. The average groundhog has a positive return. So we'll keep our fingers crossed that all of this continues. At the very top of the list, I do have to spend a couple of moments. Alex Castor was very highly ranked a couple of years ago, had a rough year, but Alex is back. I believe that is Sandy's son. So tip of the cap in the direction of the Carolinas. And at number 1 now, it is one of our institutional or rhino portfolios, if you want to call it that. In this case, it's one of our favorite screening methods. We refer to it as the launch pad. And it was inspired by the Broad Assets Investment Club out of St. Louis. And they actually won 2 or 3 years of the groundhog using that approach. What it amounts to, and I've actually shared some screening results here. Again, with a very broad brush, what they basically would do is go out looking for companies that had decent quality, fairly decent return forecasts. So what you're looking at as you go across here, good and basically excellent companies down in the quality side of things. This is projected return on value, which is going to be fairly comparable to par most of the time. So we wanted to see higher numbers there. Now the numbers not shown on this chart, just because it's I was too lazy to put them on here, is they basically look for companies that have large increases in their 2023 earnings versus their 2022 actuals, and looking forward to the 2024 earnings per share versus the 2023 forecasts. So you're basically looking for those companies that are, we know the S curve. We're basically talking about companies on the S curve where the earnings are finally breaking through and going hopefully quite positive. So that is the whole deal. Again, speaking in terms of the S curve, where you basically have sales up here doing this and earnings just breaking through down here, we're talking about somewhere near that point in time. They're looking for earnings that are explosively gaining up that trend. So there's some interesting names on here that I would run up. Again, they're screening results, so accept them as screening results. I do know that United Rentals has looked pretty interesting of late, and there's a few other companies on here that are gaining some attention.
I would say too, Mark, my second best position, Shockwave Medical, is exactly this method.
Okay. Absolutely. And the Shockwave has had a really nice run of it. Should have picked Shockwave instead of the company we did for the best small company list, probably. Speaking of the best small company list, here it is. We have made considerable gains. We have nearly caught the Wilshire 5000. here in recent weeks. We were within 1% a couple days ago, so we've trickled back a tiny bit. But there's much more green. Ken is much less grumpier when I talk to him. If we'd had Shockwave here instead of Semler, we'd be smooth sailing. But those couple regional banks have put a bit of a dent, but we are continuing to be hopeful. Anything else on here you wanted to point out, Ken?
I'm really happy to see Walker and Dunlop move into the green total return column, Mark. We've always liked what that company stands for and what it does, and to see it so far behind 3 or 4 months ago was kind of depressing, but it's moved into the green for total return and making a good move forward for relative return as well. It has a good chance of ending green in relative return before we hit that October 31st date as well.
Yeah, and they do a lot of deal making in commercial real estate, and they're good at it. But I think it's probably the canary in the coal mine. If they continue to see improving fundamentals, that really bodes very well. We were talking before we came online about Bank of the Ozarks, ticker OZK, and how they were, I believe they were at least dented by commercial real estate exposure and construction projects, that sort of thing. So if Walker and Dunlop begins to show positive signs, that bodes extremely well for the financial sector. So hope for the best. Maybe they can pull Servisfirst and Metro along with them. That would make us very, very happy. So what do we have, Ken? We've got 3.5 months to get this right. So we need for the mob to come to their senses with respect to regional banks over the next couple of months. And here is the first thing that I've been able to find that actually kind of lays potential reason for some of the malaise. You're looking at a Servisfirst pictorial. You can see that even though the price is down significantly, as you can see in the middle of the page there, let me make this just a little bit bigger. Down the middle of the page here, the projected return is actually lagged a little bit, despite the fact that the stock price has been down. That's not news. That's been the case with many of the regional banks. This is a highly respected, very high quality regional bank out of the Southeast, down in Birmingham, Alabama. And the interesting question here, and Ken, I'd like to hear your thoughts on this, is these guys have displayed a very reliable, let's call it a 10% trend when it comes to book value. And that's typically going to track pretty closely to revenues over time. And in this case, you can see that revenue growth here has been pretty solid, but I will draw the audience's attention to end of 2022 and then the downdraft with some of the stuff that's going on in the banking industry here, and then the fairly low expectations here. Those numbers are down here, by the way. I mean, they're basically the other half of that camel hump. And I don't know who's right. And maybe as we learn more over the regional bank reports here over the next few days, we can start to answer that question. But you basically have a herd of rhinos, the institutional analysts, that have significantly reduced their expectations. Are they chewing on the wrong kind of loco weed, Ken, or what's going on?
I told you before we started, Mark, that I really think that the analysts as a group aren't doing their job as well as I'd like them to do their job. I think they're throwing all the banks, the regional banks, into one big bag and shaking it up and saying they're all the same, they're all going to have issues, they're all going to go down, and they pick a number, down 10% or down 5% or down 15% or down whatever. I don't think that the analysts have a clue as to what the banks are going to do next, because that downdraft was driven by a mob, and the mob could just as easily drive an upward direction back to where all of these banks were trading 6, 7, 8 months ago. I'm waiting for earnings. I think that's the only reliable indicator right now of what might be going on. I did get one question: is book value the same as assets? For a bank, I don't think you'd be far off in regarding the two as the same. What do you think, Mark?
They're pretty
Matt?
close. I mean, bank book value is going to also accommodate or include liabilities. So it's assets minus liabilities. But generally, you look at the way the Berkshire Hathaway measures the progress made with that as mostly an insurance company / bank. Yeah, they own some businesses too, but Warren Buffett measures the book value over time. And price to book value has always been a measure of valuation for the financial industry. So yeah, but book value, and then but to the point, or perhaps expanding on the point, we're looking at a bank here, and return on assets, and these are purely assets, average assets. That is top shelf performance from this bank over time.
Yeah, well, and you're saying book value is assets minus liabilities. For these high quality banks, liabilities we're hoping are in a relatively small category. So if you want to think of them as roughly the same, go ahead, because I think what you're trying to do if you're doing an SSG is you're trying to show that the book value line or the assets line, and by the way, you can put both of those onto your graph. You don't have to imagine them. You can actually have them drawn by going over to the legend and clicking book value and then clicking assets for a bank. And what you're looking for is for those two lines to be roughly parallel to the earnings line and to the revenue line. And when you got all four of them roughly parallel, you're looking at a pretty decent bank. And then you want to look at return on average assets. And when you're seeing a 1.2, 1.3, 1.4, 1.5, or better, you're looking at a pretty high quality bank then at that point.
Yeah, that's top shelf for return on.
That's my mini bank study, Mark. I'm done.
Okay. Well, anyhow, so the question is, have the analysts, this is only followed by 4 analysts, but in general, across the regional banks, and I think Ken's right. I think they have been somewhat neglected, somewhat lazy, and it'll be interesting to see what happens to some of these revenue estimates as the days go by. So I'm not panicking. I'm a little bit uncomfortable that that's even happening when it comes to the analysts, but oh well, that's what makes markets.
I will tell you, Mark, that your high quality banks have been proactive with information sharing. If you're following Western Alliance Bank, for example, as I do, you can go to the Western Alliance website and find an investor presentation dated only 2 weeks ago. Now that's 2 weeks before earnings. They're not sharing with you anything that they're not supposed to share, but at the same time, you're getting a really good picture of where they thought they were 2 weeks before earnings. If you're interested, most of the high quality banks are not afraid and haven't been afraid during this 6-7 month period about putting out extra presentations trying to explain either how their numbers have improved or how their numbers didn't go down the way that some people reported they did.
Yeah, I think in the case of Western Alliance, I think they put out a press release which could be paraphrased as, we don't have as many assets in California as some people apparently think we do. So just an example. And then they, of course, backed it up with facts. And I do need to disclose that I'm a shareholder in Western Alliance again, and it's been for more than a few days. So.
Oh, applause.
I'm still sleeping at night, too, believe it or not.
Applause.
Performance perspectives, again, love the way this lays out. Ken was relieved that Google actually climbed back up into the top 6 again. And we just love the fact that those are our community favorites up at the top, as ranked by the most widely followed companies, probably widely followed, and I would speculate widely held by our community of investors. So all of those up at the top are there. And when you look at their long-term results, that is just the definition of compelling. Again, this is the actual returns. This is the return versus the market. The answer to the question, how much is it beating the market by on an annualized basis? Here's our demonstration portfolios. Again, an invitation, if you're not familiar with the roundtable, we will do that next Tuesday evening. The July edition of that 13 or 14 year running celebration. A lot of good fun, and it's doing pretty well. It has been between 5 and 6 for most of the last few years. It's dipped down a little bit here of late. And then I refer to this section down here as Indexville. It's okay. These numbers are all okay. I think this is just a perfect living example, especially with something like the roundtable, that you can invest in individual stocks. Discovering better companies when the prices are better is something that is absolutely achievable. Not guaranteed, but achievable. All right, so this kind of is our lead in to these two numbers that are down here at the bottom. They are normally farther up the list. And the reason they're down there is because small and medium-sized companies have been kind of hammered over the last couple of years. Again, they would normally lead Indexville, and they are down in the basement. So that's kind of our inspiration for the rest of what we're talking about. Here's another way to think about that inspiration. This is a chart from Ben Carlson, and just pointing out that anytime it's been kind of darkest before dawn, when the S&P 500 is basically in the trenches, I dare say even the toilet, if you can grit your teeth and find a way to invest in the best looking components of that or the index itself, all of this is pretty possible. I think we're seeing kind of the same situation for the smaller companies. Your thoughts, Ken?
I beg the audience's pardon and just refer them back to the chart we had last week that showed if you're willing to stay in this game for 25, 30, 35 years, you have a pretty good chance of not losing any money of any kind. So I think this just demonstrates that the longer term your horizon is, the better chance you have of keeping yourself safe and out of trouble and on the way to building a nest egg.
Absolutely. Here's a look at that Russell 2000, which is a bunch of medium and smaller sized companies. And it's kind of our inspiration for a search for opportunity. I'm hoping to find one that I can develop almost or as much conviction as I did a year ago in the QQQs that we'll talk about as our case study. But you can see that the Russell 2000 has languished pretty significantly here over the last couple of years. And it certainly is precedented. They get hammered every time you have an economic chaos, an event. But I would draw your attention to, even at the bottoms of these depths, how much higher these peaks are. Those are staggering recoveries. And I have a personal theory that we've been in kind of a self-imposed rotating recession of some kind for quite some time. A lot of the links on Manifest Investing are to articles that basically say, where's the recession, what recession? And we know that, again, a number of times when we talked about the virtues of investing in smaller and medium-sized companies, coming out of a recession is a pretty good time. I think the Rhinos have begun to sing that song. This was actually posted here, this quote, several times in different words, paraphrased in different ways, but the party is perhaps getting launched, even though it doesn't quite show up in the volume yet. Volume's high, but not certainly not the type of high that it has been before. It'll be interesting to see if that climbs and reaches new levels. Any thoughts on this, sir?
Only that, Mark, some of the big guns on the talking heads on some of my channels that I watch are beginning to question whether we may not have already seen the recession. They know that the technical definition of recession hasn't been met, but there's an awful lot of the really smart folks that are coming on indicating that maybe we didn't quite hit the definition, but maybe we've already seen the recession as bad as it's going to get, and it's passed us by. And maybe this bull market that's beginning right now is for real. When I watch Siegel move into that camp of I'm not sure we haven't already seen the recession, sort of quote, sort of unquote, in other words, paraphrase. I took notice because I respect what he has to say most of the time. He's a professor out of what is it, Wharton School of Business in Penn, I think.
That's correct. Yes.
So when he's saying things like that in public on the business channels, I'm thinking to myself, well, at least it's something I should be thinking about.
Okay, so we will be seeking opportunity there just to see if it might be there. I thought we would continue our discussion on LEAPs, options investing. So some of you, we can certainly relate to this. Is just not for everyone. Some people it gives a headache. You can read the disclaimers there. I'm inexperienced with options. I've done a few of them. I've done a few more covered calls than others, but we did do that experiment with the NASDAQ 100. Very limited sample size. What we did choose to do was an absolutely lunatic demonstration, but it worked out. Very leveraged, and QQQ actually behaved pretty well here.
We're going to have to keep this recording away from your wife, Mark. Okay.
Well, yeah, it was done with real money, so that could probably. I'll tell you what, Ken. If you show up at my house sometime and all of my suitcases are on the front porch, you'll understand. I wish I could say that'd be the first time. Anyhow, the bottom disclaimer, though, is one that I think we do need to emphasize. We received a lot of interest in these type of discussions, but we also want to acknowledge that this is about a form of speculation, a form of trading. It's not exactly the same thing, although I think some of the virtues we learn, with the Modern Investment Club movement translate pretty well. But I'm perfectly okay with anybody that wants to say, hey, I don't have time for this. I'd rather go sailing with my grandchildren. I get that. I understand that, and I respect that. Your thoughts, Ken? Did we?
You hit the nail right on the head, Mark. And I'm in the doing things with my grandchildren camp. I'm just wondering why I would spend so much time trying to worry about this kind of stuff. There reaches a point in your building of a portfolio where, and we've covered this when we were talking about the books that we had just recently read. The last two books, both of them kind of made the point that one of the things you have to understand is when is enough enough? And I might have reached the point when I have enough. And that means that I don't have to worry about a lot of this stuff as much anymore.
Yeah, and I would, in fact, Matt, I would invite you to second any of Tillinghast's attitudes on speculation. Because, you do have to do some speculating to actually operate in options, I believe.
Yeah, and even on top of that was a Motley Fool podcast, and we had one slide in it when we did that series back in May, that spectrum from gambling to investing, right? So pure gambling might be flipping a coin or roulette. Pure investing or full market investing might be index funds in terms of you don't have to pay any attention to it. If you accept average, then you can fully go away from it. But in that spectrum, options is somewhere towards the former rather than the latter compared to our style of fundamental investing or indexing. And Tillinghast's statement, again, close paraphrasing like Ken said, was anytime you put a time frame on something, it is speculation. That investing is forever, very along the lines of Warren Buffett's thoughts that our favorite holding period is forever.
Mm-hmm. And speaking of Mr. Buffett, by the way, we did a presentation on this 10 years ago that was attached to last week's bull session slide deck, so you can actually get at that. But we had mentioned that Joel Greenblatt actually dedicated a few pages to specifically LEAPs, longer-term options. And this actually just scrolls through some of the definitions that we've gotten. We fielded a lot of questions. We've actually received quite a few notes back from you guys saying, thanks, I understand this a little better now. I just need to dig in. And again, my attitude is you make the decision on whether it's right for you. I will never forget being at a Beardstown Ladies Investment Club meeting, and they had been working with their broker, Homer. And I'm sitting there and they're telling me like stuff that they've been doing, and they started talking about covered calls. And I look around the room, and I kid you not, every one of the Beardstown ladies was looking at their shoes. And I said, so I stood up and said, well, I'm here from the corporate office to bring the gods of investing, the wrath down upon you. And, of course I was kidding. What it's all about is figure it out and decide whether or not it makes sense for you. Covered calls is actually a fairly conservative and safe option. It's eligible for retirement accounts because it is. And we're going to actually cover that in a bit. But here are some of the definitions. Ken, what do you think we really need to emphasize here about what is an option?
Well, I think you need to understand the vocabulary. The first two, the most basic vocabulary is puts and calls. About halfway down the slide, Mark says that a call is the right to buy a stock. So a put would be the opposite. The put would be the right to sell a stock at some point or to get rid of a stock. So I'm going to leave it to Mark, but I think you need to keep the definition uppermost in your mind. Again, a call is the right to buy something. You're buying the right to buy something at a specified price.
And it's most consistent with our long-term thinking. If you think about being bullish and thinking about an individual stock, everything is positive, everything is optimistic. That's what a call is. You're basically putting a call in position to take advantage of an optimistic expectation. So think about puts and calls in that manner. We're going to stick with the calls, just like Joel Greenblatt says. That's not saying that there's an opportunity there, but there's your definition.
We could bring it up to present day, Mark, by saying if you bought a call on NVIDIA 30 or 40 days ago at 400, you're in really good shape right now. Okay.
Yeah, we're going to show an example of that, I think. Okay, so again, there's the rules of the game. You buy, an option, a contract, or a right or a privilege to buy a certain stock at a certain price up to a certain time. Okay, and in the case of these long-term options, they can be as much as 2.5 years out in the future. That's what makes them different from regular or vanilla options, which can run anywhere from days to a few weeks to a few months. So again, but they always have that feature. You got the privilege or opportunity to buy a stock at a certain price at a certain time. So when it works out, like Ken was just saying for NVIDIA, you get that situation. But if you bought one that went down, again, the amount that you pay for that opportunity actually expires worthless. So again, you can go back to that. I would also point out that Greenblatt walks through a case study of Wells Fargo from several years ago, and he just puts on full display the thinking behind these long-term options. Here is the other side of the coin, our friend Peter Lynch, and you can read the words there yourself. It is obviously a dissenting opinion in the world of investing, and this one here is pretty strong dissent also. Doesn't mean they're right, it just means they disagree. So again, you can use that to defend any type of position. The long presentation of the extract or excerpt from One Up on Wall Street is available in the manifest form if you want to go back and take a look at that.
Mark, Peter Lynch's quote ends at the end of the second paragraph.
That's all Peter Lynch. I guess I forgot to put. Let me fix that right now. Put two quotation.
Oh, it goes through the Warren Buffett comment. Okay, great.
Yeah, those are all Peter Lynch quotes.
Okay, great.
Okay. All right, so we covered a couple case studies. You can go back and listen to the details in the session from last week. The first one we talked about was the race for a fat pill back around the year 2010, not the current situation we're talking about with Novo Nordisk and Lilly. This was back with Arena Pharma and Vivus and one other, and Hugh actually came up with the thought that the biotech industry and sector, whatever you want to call it, back in that time frame, mid-2010, had all been excruciatingly punished. So he's looking at all these people who were vying kind of in parallel for the fat pill at the time, and he says, I'm going to buy a long-term option on all three of them I expect 2 of them to probably fail miserably, but if somebody wins this race, I want to be holding that option. And he kind of, with his tongue in his cheek or flippantly, or I guess it's a celebratory moment, he talks about, boy, it'd be nice to buy a stock for $1 and sell it for 100 again. He's done that. This company went from $1 back in 2010 when he exercised his options, and increased all the way up to 100 when the company was taken out, acquired by Pfizer approximately 10 years later. So that's a wonderful outcome. The second one that we described was a conversation that we had back in late spring, early summer 2012, where Walgreens was in a battle with Express Scripts. I called Hugh, told him I thought they were going to kiss and make up. He thought about it for a day, called me back and said, I'll go you one better. I'll tell you when they're going to kiss and make up. And he was absolutely right. He centered his entire theory on that they would kiss and make up before the Walgreens annual meeting, which happened to be in September of that year. So he went out. I actually bought 100 shares. I think I said 200 last week. It was actually 100 shares of Walgreens, and I made nearly 70% in about 2 months, going from $28 to $48. On the other hand, Hugh went out and bought, I'm not sure how many he bought, but the options at the time on Walgreens were selling for 10 cents, one contract for 10 cents. When they made their announcement that they were at least gathering near the phone booth to kiss and make up, it went from 10 cents to $2. And that was in like 2 days. And they did proceed to make up, and the ultimate value of those contracts actually exploded up to 15. So again, much like Ken was saying earlier with NVIDIA, I don't know how many shares he bought, how many contracts he executed, but could have been anywhere up into the hundreds of thousands of dollars of gain. So that's the difference. And we're looking for, what would be worth, putting yourself through this stuff. That's just one example. And now, as Ken points out, at some point we're going to have one of these not work out. We can tell a story where it didn't work out. We will share that also, if that ever does happen. I'm knocking on wood.
Okay.
All right, because I can't imagine that it could be. It's not easy, but I would come back to this quote here. Yeah, they are challenging, but when I sat down years ago, you guys have already heard this story, so I'll try to nutshell it. I sat down with the vice president of education for Options Express, which is now part of Schwab, and I said, I'm frightened of these things, these options. I don't understand them. I don't get it. I can't bring myself to even spend the time needed to understand them better. And he says, this is again over a meal, lunchtime. And he says, I don't think you understand. I know how you guys operate in your community, what you understand about the underlying stocks that are involved here. And you guys are actually the enemy. You guys are actually the ones who understand these situations and can put yourself in these type of Walgreens situations. If you go way back into the Manifest Investing archives, you'll find a fair amount of Options Express stuff. And it was because of the stuff we were doing back with them at that time. Again, his observation was our community is actually very well equipped to play in this field. We're disciplined and we pay attention. And that makes us different and uniquely different and enabled. All right. Anything else you want to add to that, Ken, or can we keep rolling?
Mark, before we started, Matt Spielman indicated that he had a friend that does a lot with options, and Ray is with us today, and I brought him into the back room. Matt, could you introduce your friend, and maybe he could speak a little bit about what happens when these don't work?
Well, first of all, there's no better manifest or bull session welcome than getting pulled into the back room on the spur of a moment. So I only have a brief history with Ray. He was a visitor at the BI Houston Model Investment Club, met on Saturday, and he was one of our first three live visitors, as we've just started meeting live in person for 2 or 3 months here. And he spent we were doing an industry study of logistics companies as a challenge to our portfolio holding of UPS. And Ray spent most of the time with a Thinkorswim trading platform screen up, looking at the options, the price history of the companies we were talking about. So I mentioned that we were a bunch of fundamental investors fumbling through options, talking through here as well, and that he might be interested, and asked if he might be interested to pitch in. So Ray, I don't know how much history you have with GoToWebinar, but if you wanted to say a couple things, you can go ahead and unmute and compliment the introduction if you want.
And I'll just say good afternoon, Ray, while he's taking care of that. And welcome. We didn't
Ray, you're self-muted. Ray, you'll have to unmute on your side. Well, we're having some technical issues here, folks.
Maybe you can trade some notes with him in the back room, Matt.
Yeah.
Okay.
Figure it out.
And when you get to the place where maybe you can unmute, we'd be glad to hear if you have any comments about options at all. Mark, let's continue with what you were saying.
Okay. And again, you can chime in whenever it makes sense. I'm going to start with the right-hand side of this slide. This was severe speculation. Again, it was inspired over probably a couple of margaritas back around Cinco de Mayo a year ago. We shared the actual results last week, and it was just basically an effort to establish a bit of a discipline. Again, we wanted to find something that had these three characteristics: undervalued according to the return forecast, and RSI trading down around near oversold levels, and then some confirmation from volume. And you can see the question there on the right. There's the answers to the questions. We're just simply looking for a return forecast that's greater than average. We do want the trading volume, whether you're eyeballing it or using some type of a number, to show relative strength historically. And we actually thought we found that with the triple Q index. And this is kind of just the view from 35,000 feet. What we're talking about, we covered this with the long-term options last week. By using these long-term options, which again can run anywhere up to 2.5 years of span, you can actually avoid the right-hand side of that time decay chart. Again, an option, as it approaches its expiration, actually approaches that zero value we've talked about a few times. And by staying up there on that plateau, it actually changes the game a little bit, kind of what we think of as a middle ground between investing and trading or speculating. And you can possibly find some comfort in doing that. Any change or amplification on that from Ray? Matt?
No, he disconnected. I've not reached in contact. I don't know if he's having more severe issues or not.
Yeah, he must be having connectivity issues. Okay,
I'll reach out to him offline, and maybe we can come back in a future session.
Okay.
Right, so this is the long-term options story, and that's what we took a look at. I went out looking for a nice display of how the actual option vehicle, in this case the TQQ January 24 calls that are shown on the upper half of the screen, how they actually vary over time. And you can see leading into that time frame last year, we actually had a pretty good run from, again, back in May, shortly after Cinco de Mayo, the NASDAQ was actually getting crucified. All those stocks that have been so hot this year were ice cold a little over a year ago, but we did have some volume down here. So there was some interest in them, a little bit of an uptick in volume. I think you can see that volume is higher than it's been ever since then. So again, we had a potentially oversold. We had many of the stocks showing pretty good values, Amazon and Apple and and all of those type of companies were ending up on many of our screens. So we actually took an initial position in this option, bought it here, and actually did some selling along the way. We listed out all those transactions, came back to it a few months later when this happened again with actually added some shares and then hung on to them until they went from over here back up to here. Now, all of those contracts have been sold at this point, but every single one of them worked out for a net gain. So that was, I believe that's a happy accident in some cases. But again, think about, we're talking about multiple months involved here. And as it says here on this previous slide, we're looking at a holding period of quite a long period of time for the average option in those contracts that we pursued a year ago. So I like to be able to look at the top, at those two charts, one over the other. Again, I think one of the things that many people struggle with is, and Peter Lynch covered it, I mean, there's nothing behind that option that is as tangible as we feel when we're actually investing in Microsoft or a company like that. You're investing in a contract, which possibly executable, maybe not, maybe expires worthless. So it's a little bit different, but we're not always talking about holding it until expiration. In this case, buying here, selling here. So you can actually go in and out of them pretty readily, especially when you're dealing with something with a fair amount of liquidity. Okay, any thoughts on that, Ken?
Nope, I understand what you're doing, and you're just convincing me that my position is pretty decent, Mark. Okay.
Okay, so the first cousin to that madness that we did a year ago, if we did find opportunity in the Russell 2000, here's that first cousin to that triple Q leveraged fund, which again, we don't necessarily recommend until you really understand the nature of these animals. This is the Wilshire 2000, but it's 3 times leveraged, so it's going to be much more volatile. Again, we're looking for the Wilshire 2000, Russell 2000 to be undervalued by terms of the return forecast, and then also in a range where it's been kind of camping out down here, hopefully taking off for the virtue of our best small company portfolio. But it's been kind of trading in that channel for a little while now, and if it breaks out, as suggested by some of the stuff we see happening, could be very rewarding. How rewarding? You can do the math. From levels like this to levels like this, it can be dramatic. It can be extremely dramatic. So here is just a look at one example. Just want to reinforce, we're talking about this TNA, which is that triple leveraged Russell 2000 fund. We are going out all the way to January 2025, so we've got a lot of time. And we're looking at a $50 position. So again, it's actually working out fairly well right now, that getting in somewhere back in this time frame appears to hold a considerable amount of promise. So,
okay, Mark, could you stay on that slide for a moment?
Mm-hmm.
And could you explain with the numbers up in the upper left-hand corner, what did you actually pay for the option? And can we read that in the code for the option?
Okay, the amount that I actually paid was 6.00, so it's actually up from the purchase. But if you were buying this one at this moment in time, it would be a contract for 670. That's going to, since that converts to 100 shares, you're actually talking about $670 that you're placing at risk in this particular speculation or option.
Okay, makes sense.
So I invested 600. As of today, it's worth about 800. We're talking about just 3 or 4 days.
Okay, and that 5 in the middle of all the zeros, what's that represent, Mark?
All of this is the price. They use 4 trailing zeros and 3 leading zeros. That's 50. So that's this $50 expiration. So I'm basically saying I believe that it's possible for this particular measure of the Russell 2000 to return to 50. Now look at this chart. Keep in mind that we've got a couple of years on here for this long-term option. So somewhere out here. Do I believe it's impossible that this could reach back to the 50 level? And my answer to that is I don't know, but I think it's viable.
Okay,
I think it's actually probable.
and could you explain to us what the 670 means then?
The 670 is the actual price of the option at that moment in time. That's
Okay,
the quoted
but
price.
it's not the price of the of what we're putting the option on, though. That's the
Right.
price of the option itself, 670, right?
Right. And the underlying, or in this case, this index is right around 40.
$40.29, that one in dark black there. Okay. All right. And so the bet right now is that it could reach 50, right? And
Correct.
as it gets closer to 50, we would expect that price there to move closer to zero. Is that correct?
Well, it's actually going to move up until you get into that final decay part of the curve. It's going to,
Okay.
this is actually going to follow the price of the index until you get within, most people believe, within 60 days of expiration. In other words, December
Okay.
2024.
And then it would start to decay back from wherever it is back down to zero then. Okay.
And
All right. And all right, go on.
And I was just going to say, I didn't experience that with any of the ones that I had, but I can tell you it would have made sleeping at night difficult for me.
Okay, and what's that 1085 at the very end of it indicate, Mark?
I'm not sure unless it actually got up that high this morning. I'll have to look at that. I don't know what that is.
Okay.
All right. So what are you actually investing in? You're investing in a leveraged investment of these type of companies. And the answer to the question, is it undervalued? Well, the stock market is around 9 or 10% for the return forecast. And in the case of using smaller and maybe some of the smaller medium-sized companies, it's probably a good idea, especially early stage, to use PROVE, projected return on value, and that is a considerable projected return on value. So the average value is actually fairly strong for this collection of stocks. Keep in mind that this is only the top 25 or so, and there's a whole bunch of them underneath the surface. But you'll see that there's quite a few tickers. There's a few there that we recognize, but you are shopping in relatively uncharted waters a little bit. And again, just to make the point that it has been languishing fairly lately.
Would it be wise to make the point also, Mark, that in a normal mutual fund, when you look at the top 25% of holdings, you're looking at a lot more than just 6% of the total assets. In this one, the top 25 represents a much smaller piece of the whole than it would in a normal mutual fund. Is that fair to say?
That's more than fair to say. It's absolutely true.
Okay.
And in this case, you're looking at a very, very diversified. It doesn't even count. It's way beyond diversified. Okay.
And if you're interested in the entire list of the Russell 2000, that should be something that would be easily searched in a search engine on your computer, correct?
Yeah, and you can find, I don't know if it's the top 40 or 50 at Morningstar, or there's a few places that will actually list them all out. They won't give our return forecasts or quality ratings, but you know that.
Yeah.
All right. So let's go ahead and wrap up. So that is, we'll actually spend a little bit of time watching this and exploring it in a little bit more detail. I will be watching more closely. This type of activity that I see on the right-hand side of the chart, if this were to drop back from 40 down into the mid-30s, or perhaps even down here to this 30, I'm probably going to get very interested in this as a medium-term speculation. And we, of course, we'll share that in our forum and possibly during these bull sessions. Okay? So that just gives you a feel for how those behave over time, and we'll keep coming back to the subject as required. So let's talk for just a few minutes about covered calls. Again, it's a different option strategy. We are at 3 o'clock, so I'm just going to give a quick introduction. We can come back to this and talk about it in greater detail. I have done a little bit more of this. I will confess I'm not disciplined to do it as often as I should. And Ken, I think we probably should come back and dig in a little bit deeper as to how this might be a prudent sell strategy. But in this situation, it's actually kind of the opposite. You're talking about something that you already own. You actually have 100 shares of something in your portfolio, and you're actually the owner of the stock, and you're writing this contract or option against that holding, against that position, okay? A little bit different. It's not something that you don't own. You actually own it. You're just selling that opportunity, and you receive the proceeds from that sale of that opportunity. It's exactly the opposite of what we talked about for the long-term option. You're actually trying to get out on the end of that decay curve where the price goes from, let's say, a few dollars and approaches zero as the option expires. So you're basically selling it. You're getting the money for selling it. And if the clock runs out on it and it's not something that is executable, you just keep the money. So this is basically what JEPI does when we talk about JEPI and some of our other stuff. So here's a quick demonstration. You might take a portfolio. I chose our tin cup model portfolio, ranked it by the return forecast. So which one is the weakest? I'm seeing Regeneron Pharma. I happen to know that they've had a little bit of trouble with their eye health product. This number we have been a little bit concerned about longer term, but again, this is a company that I might not mind selling at a certain price. Okay, what would that price be? Let's come back to that one in just a second. So here's a look at Regeneron. You can see that it's had a really nice run. Stock price-wise, it's taken off pretty well. That has driven the return forecast down, providing a potential selling opportunity for portfolios where it makes sense to do so. It's in mid-single digits on the return forecast. Even if you look at the projected return on value, that's only a few percentage points higher. That's simply suggesting that maybe that PE ratio is a little bit too low. We'll talk about that some more. But what we do offer is you can actually take a look at if the sell point is somewhere around money market rates of returns. I just used 4% for this demonstration. We might be willing to consider selling this at $740. So that is our theoretical strike price on it. So here's a look at Regeneron over the last few months. Here's the problem that they had with their product, causing that downdraft. So this could be a company that does languish a little bit on the downside with some price distress. So, again, we'd be talking about, would we be willing to sell it somewhere up in this range? Okay. So you can go out, find an option. Again, it's going to be a little bit shorter, September 2023. Here's your 740 price. That's only 6 weeks from now. And you're basically saying, okay, if you want to give me $740 for this, the price to do that is this number right here. So Tin Cup would receive $2,590. And if the price reaches or exceeds 740, we may lose 100 shares of Regeneron. But if it doesn't happen, if this continues to languish down here, which is something that would be quite viable or feasible, you keep the $25.90. So this is, again, just an introductory thought to how might you think of a covered call for a portfolio. Again, a company you might be willing to sell, giving it consideration to come up with the price at which you would be willing to sell. You might add a little bit of a margin to that, but you're going to come up with a number much in the same way. Thoughts or questions, Ken?
Well, again, my eye goes to the 54.25 at the end. I really would like to know what that number represents. It's obviously a dollar amount, but at the moment, it's pretty straightforward. It's making sense.
Yeah, and don't let the scale here, it doesn't start at zero down here. You might want to make a note of that because it looks like it went towards zero. That's not zero. Just a scale change situation. So we'll come back and take a closer look at these, at that as a demonstration. But again, I do think that a covered call as a conservative strategy does make some sense, and we can talk more about it as a selling criteria also. All right, any other questions at this point, Ken?
No, we haven't generated a lot of questions today, Mark. So we're in pretty good shape.
I do think a lot of people within our community have used covered calls. I think that's less of an unknown when it comes to the people we work with. All right. Here's a reminder that we do archive all of these sessions, including last week's session, shown there on the upper left with Ken and his Rascals. They're all on YouTube. Just go to the Manifest Investing page. Please consider subscribing, and we'll let you know anytime that new content is added. And then we're approaching that time of year when the God's country up in northern Michigan starts looking pretty good. And you, of course, are familiar with that scene, Ken.
Certainly, the Mighty Mac.
The Mackinac Bridge between the lower peninsula of Michigan and the upper peninsula. Good stuff. So with that, I think we can go ahead and shut down. You say we're pretty well caught up on questions?
Absolutely.
Okay. Well, let us know what you're curious about, what questions are triggered as far as you're concerned. We'll continue to do real demonstrations. I will be watching this very carefully because as we displayed last week with the QQQ options over the last year, those were quite compelling. And I'm not so sure that that same type of situation isn't setting up perhaps to a little bit lesser or a less well-defined degree, but it'll be kind of fun to see what happens as it goes. So with that, I think we can say good afternoon to Darla and Maria. And we'll see you in about a week. We will, of course, be doing a little bit of prep for the roundtable a week from today. Anything else on your mind at this point, sir?
Nothing else, Mark. Just have yourself a good, safe week, and we'll talk to everybody again next Tuesday.
Okay.
Good afternoon, all.
Thanks. Thanks, Matt.
Yep.